So we had a miss on the CPI, a miss on the PPI as well. What do you think it means for the Fed?
Hey, Martin, good morning. Well, this doesn't mean like mission complete. This is a good step, as Evan said yesterday. But, you have to keep in mind that the levels not only are very elevated, but if you strip off any of the, say, headline noise, some of the, let's say, trim mean and median CPI, even PPI measures show still upward pressure. So the Fed cannot be done here. It's going to continue to hike. And it probably means that the 75 basis point rate hike remains on the table. And it's interesting that as much as the yield curve, as you say, steepened today, and as in short-term rates fell a little bit on this number, the pricing on the Fed funds futures and Eurodollar futures shows that we're still more towards the 75 basis point rate hike. And I think that is because of the guidance that all these Fed speakers keep giving us. Just don't be complacent here. We're going to continue. And I think it's the stage we'll stay in until we reach a point that the Fed doesn't have to hike. I think that's still months away from now, from compared to these softer numbers as come out.
Okay. And Ben, we like to talk about the altitude of the curve, whether it's lifting or staying put, whether it's steepening, et cetera. But one thing that you like to look very closely at, and I think we don't talk enough about, is where real yields are. This is net of inflation. And you've noticed, and I'm glad you're pointing it out, that across the entire curve, real yields are now positive.
Yeah, I think it's really important, Martin, because in say June, July, real yields started to decline mysteriously and actually became in certain parts of the yield curve again negative. And that has, I think, helped financial conditions, as we say, to loosen quite a bit. And it's always been a good fuel to the fire for equities and risk assets. And as we are rallying with equities now, those real yields are moving up back above positive. And what I take from that is that one, the market, the inflation market is saying like, no, financial conditions actually should start to tighten again as the Fed continues. And secondly, it's also about liquidity, I think, that's playing here in the August month. So the market, I think, on the one hand, is quite wary of that if equities start to rally too much, financial conditions get too loose, these real yields are going to start rising. So pay attention to that because I think it's the first sign of somewhat change ahead of us.